everyone, Ashleigh Fletcher, loan officer with CMG Home Loans. I'm excited today to be able to introduce everyone to our very own Mr. Dave Herbst, VP of our exclusive all-in-one loan product. This exclusive product is a financial game changer to homeowners and future home buyers in the great state of Texas. I'm going to have Mr. Herbst tell us about the all-in-one product and how this product is a financial victory to any homeowner that qualifies. Mr. Herbst, take it away.
Hey, Ashleigh, it's good to be with you. I appreciate the opportunity. I love the word victory. It's exactly what it's designed to do and does. It's a dynamic product that we have had out and available across the United States since 2005, actually. So it's not a brand new product. It certainly is newer for a lot of people to learn about. That's partly because we don't tend to advertise broadly as a lender. We tend to believe that people are better served by people, people that know what they're doing and have invested time in themselves and into the industry, understanding the options and how to place them, in suitable situations. So a lot of people just by that, process haven't heard of this product, but it's not new. The one part that is new is the opportunity to use it for primary residences in the state of Texas homestead properties. And that's a new feature that we released just this year, May of 2022. We're really excited about it, but it's a dynamic instrument, and I'm happy to be here with you to share the news about it.
Well, we're excited to hear about it because this is a completely different type of loan that Texans out there will love to take advantage of.
It's actually a pretty simple product, just in terms of structure. But let me begin by really kind of illustrating why we pushed this forward and started that process nearly 20 years ago. One of the things about mortgage finance and real estate in general, one of the things that we know is that most Americans need to borrow money in order to buy and possess real estate, without question. The mortgage is a very vital component of the health of our housing market. It certainly provides people an opportunity to buy and own real estate. The issue is that although I think we do a really good job of helping people get into their mortgages, I think that we as an industry don't necessarily do as good of a job helping people get out of their mortgages, right? So for something that's so, necessary, it's also tends to be very kind of cumbersome and rigid. Mortgages are really slow by nature, slow payment plans. And I would argue that, the conventional mortgages that we've been using since really the 1930s, although they certainly serve a purpose for say new home buyers and people that tend to be maybe in their earlier periods of their life, they're approaching their peak earning years. The argument could be made easily that the standard mortgages don't necessarily fulfill a variety of other needs that that people that are more established tend to have and think about daily. There's other things that people need to really kind of, concern themselves with and focus on financially. Retirement security in the future is one of them. Maybe affording college tuition costs for children is another without having to go deeper into debt. It's just expensive to live, right? And the mortgage is the biggest expense we all commit ourselves to. We find that people, if given the opportunity, would love to save money on their expenses. It's hard to do without changing your lifestyle. You can't just snap your fingers and make more money, right? Not all of us can do that. And so, we look to the mortgage and say, here's a place, here's a financial tool that, is vital. It's needed, but it really hasn't innovated. It hasn't changed much, really since inception, 1938. So about 20 years ago, we started down the path of really redesigning, reimagining, what the mortgage could be. And we took some ideas that are commonplace globally in other countries. Also ideas that are in place here in the United States with commercial banking or even private banking. And we applied them to our product that we call the all-in-one loan. And it's very simple. It's intended to help people avoid mortgage interest cost. The amount of interest that comes with a loan, whether you're, at today's interest rates or yesterday's interest rates, lower than now. Either way, mortgages are expensive. They're designed to actually collect or charge most of that interest cost up front in the payment structure. And again, we think that's prohibitive. That slows people down. What if there was a mortgage product that simply paid principal first, recomputed interest costs on a daily basis, reduced monthly interest payment obligation ongoingly, driving the cost of the mortgage down to zero faster. And what if you could achieve all that without depending on, favorable interest rate cycles? What if you could achieve that without changing your spending or disrupting your lifestyle? Those are the things that we set out to achieve. And we've done that. And we find most people like that stuff. That's exactly what most of us would like. Have an easier time saving money and putting away for our future and, funding other obligations. The all-in-one loan achieves this by essentially melding or merging together the mortgage with personal banking. So in other words, the mortgage loan itself is bundled together with transactional banking aspects or a checking account. This allows customers to freely use their income without locking it up into a mortgage permanently to reduce their daily and monthly and annual loan balance faster. So in other words, people can deposit money and spend money directly out of their mortgage in order to offset the costs that typically come with a mortgage and live the way they presently do without any change. So I know that's just a quick illustration or description of the product, but that's essentially what it is. It's very practical.
Very simple product out there. So to follow that up, I do have a few questions that I'd like us to kind of address right now. So I live in the great state of Texas, and one thing that a lot of people are used to are our A6 Texas cash outs. It's a first lien cash out that is, you can do 15, 20, or 30-year terms on there. How is the all-in-one maybe more beneficial than our traditional Texas cash out product?
Yeah. So the mortgage security, which makes up the all-in-one loan, is a first lien position home equity line of credit. So it does provide access to equity money. That's really the key feature of the product, right? I mean, we all know that we can pay down debt faster to save money and time, but typical mortgage instruments are rigid in that, you could do a cash out refinance. You've elevated your debt level, and you're not going to necessarily focus on putting money back into that mortgage to reduce it ongoingly faster, because mortgages lock that money up permanently. Having a mortgage that finances real estate that is a first lien position home equity line of credit, meaning that people can put money in and take money back out and put money back into it freely over the term of the product, without it being locked up, is really the key benefit, and makes it safer, much more rewarding, much more flexible, right? To achieve these things. The difference is in terms of how we've structured this to comply with Texas A6 rules, is that, and it's best described, I guess, illustrated by allowing me to describe kind of the two different versions of the all-in-one loan. The very first version of the standard all-in-one loan that we apply for investment properties and second homes, as well as primary residences outside the state of Texas, is such where the linked checking account that comes with your all-in-one loan line of credit, it sweeps deposits directly to the line of credit to pay down principal. So in other words, when you have this on an investment property and you deposit maybe your rental income directly into your all-in-one loan checking account, that money is swept. It's called a digital sweep. So it transfers the money automatically for the customer directly to the HELOC, and that pays down their principal balance that day by that amount. That's a benefit because interest is recomputing nightly. So you now have offset the interest cost just by using your income. In the Homestead version, that automatic sweep actually doesn't occur. And this is part of the ways that one of the ways that we actually comply with Texas A6 rules. The deposit will hit the checking account, and then from there, the customer decides what they need in the near term, what they don't need in the near term in terms of their cash, and they have the opportunity to move that money over to the all-in-one loan HELOC freely. They can do that immediately, and it's an immediate sweep or digital transfer where it pays down the balance by whatever amount they want to. They can set that in advance. They can move money back out by making an advance using the linked checking account. But this is one of the ways that we comply with, the rules in Texas, is to not automatically sweep money to the line of credit, but instead allowing the customer to keep what they need on hand for bills and expenses in the checking account, especially for near-term needs. Okay. There's some other items that are a little bit different, but as you know, Texas has some some rules centered on use of equity money out of the homestead. And so this is purely designed to make sure that we comply, but also provide people an opportunity to save easier.
Exactly. And the people who take advantage of this will definitely appreciate it. Another question that I have is that you kind of mentioned that people can borrow from their all-in-one, pay it off, borrow. So how do we ensure that a client at the end of their all-in-one term do not end up with a balloon payment?
Yeah, it's a great question. So it's also a very uniquely designed line of credit. There is no balloon payment. The line of credit limit that we establish based on some qualifying aspects when a customer applies for this loan, it's much like any other traditional mortgage. We're looking at their income, reserves, their debt to income ratios, and we have a qualifying limit for the line of credit itself. And so once we establish that and close the loan, that line of credit limit will be available for the customer to borrow back up to whenever they want. That's their money. So imagine maybe as an example, achieving a $500,000 all-in-one loan, line of credit for your home. You've paid down your mortgage balance fast, right? Let's say 12 months later, you only owe $350,000. Well, you have the ability to just write a check. Essentially, you can move that money back out and utilize that money freely all the way back up to that $500,000 line of credit. After the 10th year, however, we want to begin to enforce a very comfortable pay down and pay off. And this is how we solve the issue of, generally speaking, lines of credit come with either a restructured P&I payment after 10 years, or they come with a balloon payment, even worse. So we don't want any of that. What we want to do is begin to reduce the borrowing limit on the line of credit incrementally, slowly over the remaining 20 years, so that we help people achieve payoff, worst case by the 30th year, without forcing them into a balloon payment. So it's a unique structure that keeps the line of credit liquid, keeps people's money liquid for a lot longer than a traditional loan, but without the additional burden of a balloon payment.
Mm-hmm. And that's a big concern for a lot of people with these types of loans, is having a balloon note at the very end of it.
That's right.
Another question is, I know we chatted about them kind of being adjustable rates, and right now anybody that doesn't live under a rock knows that rates are pretty volatile in our industry right now. Is this option still a good option, even though a majority of them are adjustable rates, versus going with a standard 30-year fixed product?
Yeah, it's certainly a good option. I would encourage everybody out there to explore options, and not just robotically assume that the kind of the status quo or the conventional thinking is the best way and only way to do something, especially when it comes to finance. Mm-hmm. Although there's been a lack of innovation, I believe out of our industry. And when I say innovation, I what I mean by that is the restructure of how money is used, in the mortgage, by the mortgage. We've done that. We've accomplished that with this product. But I don't fault people for, kind of thinking at least that the standard mortgage is the best option. I think also a lot of people are really taught that fixing in your expenses is creates safety, right? Lowers risk. Especially, during cycles like now where the cost of living has gone up pretty dramatically. By the way, inflation is not a new topic. Things have been going up in price for a very long time. It's this sort of omnipresent, force that really puts pressure, on our disposable income. Slowly but surely, that disposable income and our ability to actually save money and fund other things erodes away. Not just due to COVID and supply chain disruption and all this other stuff, but that just happens ongoingly over time. Mm-hmm. All the more reason we argue reducing your expense, your monthly expense, is a good idea. So here's the difference. On our loan, it just comes to math. There are three mathematical variables in the mortgage equation. These are the same variables that play when you invest money, by the way. Put your money into an investment account and you want to grow the value of that asset. Same three variables as applied to a mortgage. Your rate matters, right? The interest rate you pay or the interest rate you gain, same, it does matter. How much you borrow and how much you owe, right? Are you going to owe a lot for a very long time? Or are you going to be able to reduce that amount rapidly? The other variable is the time. How long are you going to owe somebody money, right? So these variables at play with investing money also, have an impact on the value of that asset. We know that we don't control, rates when it comes to, to saving money for long-term needs. Interest rates or, APY tend to fluctuate, right? Nobody controls the market. So rates fluctuate over time, but the way we build assets, through investing money is by doing it for longer. So we focus on time. And also we try to, we're taught to pay ourselves first, like invest money, save money with as much as you can afford. So we also focus on principal balance, build your balance, right? And do it for longer. Let rates be rates. By the time you retire, you should have enough, should be okay. When it comes to managing debt and reducing the cost of debt, all we're doing is applying the same mathematical logic to the equation that already exists. Our loan depends less on interest rates to save people money than a traditional loan. What it depends on is the customer's ability to reduce what they owe faster. And so they spend less time in debt. That offsets cost. The question is, can you have a higher interest rate loan and save money and time? Yes, of course. You can have a significantly higher interest rate loan and avoid a ton of costs due to the principal falling faster. So that's the methodology behind, that drives the product. We do offer a 1-month variable option, so the rate can adjust once a month, or customers can also choose a 3-year fixed option. And they can also choose a 5-year fixed option. Those are all, based on or defined by occupancy, of the property. But all those options are available. Once the fixed period is over, then it turns into a monthly variable. And that's, we created a product that just gives more control of, full control of the principal balance, much greater influence over the cost. And using a rate structure that they share with us. They share the benefit and the risk with us as rates move, up and down. Rates have certainly come up this year. We know that. We use the 1-year CMT index, the constant maturity treasury, and it's slightly above its lifetime average or its historic average. Looking back about 25, 30 years, it's averaged about 2%. We expect it to come back down. Rates ebb and flow up and down over time. So again, a rate is only 1/3 of the total equation. This loan is engineered to put borrowers in greater control of the other 2/3.
Perfect. So how is the interest on this loan calculated?
Mm-hmm. Yeah. It's simple interest, recomputing nightly on the principal balance outstanding. Again, the customer has full control. If you owe $300,000 on your loan today and you deposit $10,000 into it, and in the case of a homestead property, you choose to transfer that $10,000 over to the line of credit, not only do those dollars remain liquid and available for advancing back out, but what they do is they're used to pay down the balance by $10,000 that day. Interest is just computed nightly. It's outstanding balance by the rate, the interest rate, divided by 365 days equals that day's interest expense. Now, we don't charge customers, as you know, we don't charge daily. This is just recomputing daily. And at the end of the month, depending on where the balance was, all based on the balance activity, the total interest from the month is just, added up, and that becomes the interest payment. That interest payment isn't due until the 21st of each new month. So in real time, we're in the month of October right now. So October 21st, the interest payment for September, which equals the cumulative daily interest from September, 30 days worth, will be due. That interest payment's the minimum payment obligation on the loan. Anything left in the line of credit already went towards principal, and that helps reduce interest cost ongoingly.
Perfect. Because that kind of leads me to my next question. I know, because I have a couple of these loans, and I love going in after I've made a payment and check back a couple of days later. And I like to see that if I put 5,000 on there, I see my balance go down by 5,000. So a lot of people,
it's gratifying.
Yeah, it's amazing versus when you put $5,000 down on a traditional loan, you might see your balance go down by a couple $100. It's just so much nicer seeing your balance go down so much faster. So a lot of people ask, when is the interest paid? Is it paid separate? Is it taken out of the money that you pay every month? How is that really paid?
Yeah, that's right. It is paid separately, and that's another key feature of it. Not even a traditional HELOC will will separate your principal contribution towards your loan from the interest cost. When interest is due, lenders want their interest. And I'm not saying that we don't, but what we do is we separate those events from each other. Anything put forth towards the mortgage, the line of credit, by way of using the linked checking account, all of that money goes directly to principal, regardless of the amount, the frequency of transfer or deposit. And regardless of the actual day of the month that's done, whether interest is actually technically due or not, 100% of what you put towards the mortgage goes towards principal in its entirety. So it actually serves to reduce the balance. The interest payments are a separate event. That occurs on the 21st of each new month after the customers had an opportunity to control their principal in an effort to reduce their cost. So, it's a separate event altogether. On the Homestead version of the all-in-one loan, that payment is required to be made or remitted by the customer. They initiate that payment. On the non-Homestead, so if this loan was applied to an investment property or second home in the state of Texas, that interest payment that's due on the 21st of that new month is just simply swept from the line of credit automatically for the customer. They actually don't have to lift a finger. It's just simply drafted out of their line because it's presumed that that's where their money is that they would use to pay for a mortgage anyway.
Let's say that you're one of the people that took advantage of the low rates in 20 and 21. Would you, if you have like the 3.75, would you still want to entertain just looking at the all-in-one and seeing if this is something that would benefit you to pay it off faster?
Yeah, absolutely. I like to remind people of some, very basic concepts. One of those is that, although, 3%, 3.5%, 3.75, or even 4%, relatively speaking, is a low interest rate, right? I know that's lower than what you would get today. However, it's not zero. Zero is lower than 3% or even 2.75% or 2.5%. I don't think that many people wake up on a daily basis happy that they owe somebody else money and they're paying 3% on it. I just don't. I think people want zero, or at least they want the opportunity to drive their cost to zero faster. And that's the question. How are you getting there? Is that process unfolding very slowly for you? Does it give you an opportunity to reduce your cost, lower than 3% or 3.5%, safely? Or does the mortgage not do those things? The question I like to ask people is, do you want to speed that process up or delay it? Zero is the goal. So, if you could drive your cost to zero more rapidly, without having to depend on, favorable interest rates, but rather, depending on your ability to cash flow in and out of an instrument that uses that money daily to create a benefit, then, that's exactly what it does. And that's why people should consider this. Even those people with low rates on their fixed mortgages, they're still paying more than zero. And the question is, do they want to pay that for a long period of time, or they want to get to zero sooner?
Exactly. That's a great idea right there. And now my last question is, when I've tried to talk to people about this product, they kind of, just the way that we've grown up with how the mortgage loans are traditionally, they're like, well, y'all want your money. You want us to pay longer and longer. What's in it for you to get us to pay our house off faster? Why would any lender out there want to do a loan that people get paid off so fast that they're not making any money anymore?
Yeah, I certainly understand the skepticism and kind of the desire to try to look for the smoke and mirrors or the catch, if you will. The world of finance isn't necessarily known for safe innovation, right? The innovation we've seen in the past certainly got a lot of people into trouble. This is designed totally differently. It's designed, and again, as a reminder, we've had it out since 2005. It serves to reduce risk in lending and borrowing. We've simply made a product that helps people pay down their balance. It's money we owe. You borrow money, you got to repay it. Well, if you could, kind of speed that process up and do it safely while retaining access to the money you're using to do that with, then it becomes very comfortable or very practical, right? And that's the beauty of linking it with, the banking instrument. So, ultimately what's in it for us is reduced risk. It's riskier for us, in the end to create products that keep people in debt for longer, slow their process of repayment down to where you carry a higher balance for longer. and it's riskier potentially because housing prices could fluctuate. They could go up and down. We know that over time they go up. But there could be some periods of time where we see housing prices level off or even come down. As a lender, would we rather be in a position where our customers owe more on their mortgages on those homes where value is coming down a little bit? Of course not. We would rather be in a position where that housing price or value fluctuation is still substantially higher than what our customer owes on, the balance on their mortgage. This puts us and our customers in a better place. Secondarily, we also tend to not see people refinance out of this as frequently as they would with a traditional loan. It's called runoff or the attrition rate, and it's near zero on this product. People are not refinancing out of this because they need another mortgage product to go fulfill some need. All those needs are built into it already. It solves a variety of different problems. So we tend to build a stickier relationship with customers. So we keep them around for longer. And that's also very vital to us. So yes, it's intended to help people save and cut cost and spend less on mortgage interest. But, we can achieve a very, viable asset for us by providing the customer an easier way to reduce their costs. But it also provides them the flexibility to continue to use it for other things. What we have found over the last 17 plus years in offering the product is that people tend to find other needs, and other uses, buy other real estate, which is great. They also refer people, people love their all-in-one loans. And I don't know that people love their 30-year fixed mortgages or 15-year mortgages. They love their all-in-one loans. It just opens up opportunity, and we get to be a part of that process and providing additional solutions for them.
That's awesome. I mean, again, I have a couple of these loans, and, having the amount of investment properties that I have, I never thought I would be able to retire from this industry because even though I have tenants paying the mortgage, I've always wanted to have my mortgages paid off so I can live off of that income. And with this loan, I have 2 of them. It's going to help me reach my goal a lot faster. And when this product first came out, I honestly was extremely skeptical. And then I took out one, and I'm like, wow, I'm able to take this cash and pay off this house, and then, you just quickly build up that equity again to where you can withdraw the equity and pay off another house, buy another house, take care of, student loan debt, whatever is out there. And it's just a fantastic product that CMG has came out with.
That's it. I mean, I love hearing, stories like yours, Ashleigh. It continues to, fortify our effort, the reason for our effort in this space. Again, the industry has really sort of been providing a one size fits all solution for a lot of years. We know our customers aren't all the same. We know that we enter certain stages in our lives where we take on more obligation, more responsibility. We have other needs, other, unplanned events that occur routinely, and we've got to maneuver through those things. The mortgage tends to be statistically the largest expense we'll ever commit ourselves to in our lifetime. And it's a very rigid tool as financial products go. This just opens up the opportunity to, use the home as an instrument, but also use your cash flow to reduce the cost of the financing you once needed or need to carry now, more rapidly. And that's so it helps people just maneuver through a period of their life that they need that.
Well, I know I've taken up quite a bit of your time today. All of this is so informative, and I hope anybody that watches this will take this into consideration as a tool to use. And again, if anybody's in Texas looking for a refinance like this or to purchase a house through a loan like this, give us a call, and we'll be more than happy to chat with y'all. Great. Well, thank you again for your time, Mr. Herbst, and we'll hopefully have another video like this.
Yeah, we will. My pleasure. Thanks, Ashleigh.
Have a good day. Bye-bye.